One of the great things about working in public practice, especially when you work on large engagements, by the time you're in your late 20s, say 26, 27 years old, and you're a manager, you can be managing teams of 10 to 15 people. And so you start to learn just trial by fire how to be a manager, how to delegate, how to coach, how to motivate people that are otherwise burned out and exhausted. And that's an incredible experience at that age and that stage of your career where you're less than 5 years into your career and you're already a manager of a significant team. And so it's a pretty fantastic experience, no doubt, and it has lots of lessons that you can apply even outside of public practice.
Welcome to People Who Perform, the Real Estate Careers Podcast. Each episode will bring you conversations from business leaders and up-and-coming stars in the commercial real estate industry in Canada. Our guests will share their unique career journeys, passions, and advice on what it takes to be successful in this industry. This podcast is brought to you by Highview Partners, connecting people who perform in Canadian real estate.
I'm your host, Richard Costello, and I'm pleased to introduce Doug Allan. Doug is Vice President of Finance and Operations with Burrard Properties, a private family company founded in 1979, and he's tasked with managing project debt and equity capital. Prior to working in commercial real estate, Doug spent over 8 years in public accounting with EY. Doug has a BComm from McGill University and is a chartered professional accountant. Doug is also the author of a new book called A Fighting Chance, The High School Finance and Education Everyone Deserves, which we'll hear more about in this episode. So first of all, Doug, a big welcome to you and thank you for joining us.
Well, thanks very much for having me. It's great to be here.
Well, I'm interested to learn, I guess we'll get straight into this, more about your decision to pursue accounting as a career and how that came about for you. And maybe if you can share maybe some of the influences that might have led to that decision.
Sure. It's an interesting story because my father was an entrepreneur and he began his career in sales and marketing. And so as I came up, as a teenager and watched him succeed in business, that was the path that made the most logical sense to me. I should go into sales and marketing because that's the path to the C-suite. So I went to McGill to earn my BComm, and in the first and second year, you're going through the ropes of your introductory courses into marketing and finance and accounting and operational management and so on and so forth. And the marketing side of things really just was not clicking with me, but I kept getting straight A's in all of my accounting and finance courses. So I said, well, this seems like it's something that I click with. And going back in my family, I'm actually a fourth generation chartered accountant, and multiple people along my family line have been medalists and UFI award winners. So I think part of it's in the blood.
Well, the world over, I guess there's this understanding of what it means to work at one of the big four public accounting firms. What for you were the big takeaways from your time in this environment?
Yeah, no, it's a very unique work environment. Because when you go into Big Four, you're usually put into the audit practice, and you're one of potentially dozens of other people within your rank that are now being placed onto different engagements. And so it's this sort of unique internal market for staff that you become part of, which makes it extremely competitive, right? Because every senior manager, every partner is trying to staff their engagements with the best people in the firm. So it becomes a little bit of a competitive game where you need to figure out how do you get to the top of the pack. And what I learned pretty early on, which was beneficial, was the best way to get to the top of the pack is to appeal to the what do the partners and senior managers really want, and that's growing their businesses, their portfolios, and becoming more profitable. So if you can focus on the business of public practice accounting, the office itself, as opposed to the engagements, you'll do much better. And so it's kind of this lesson of working on the business and not just in the business, which applies across any business really that you work in. Try and make sure you're focusing on how do I reduce costs? How do I bring in more work, more revenue? How do I bring more profits and more value to the owners? And if you can do that, they'll love you to death forever.
So that was kind of how to succeed in public practice. Perhaps like once you have left that environment, what were the things that you've been able to take from your time there that have helped you?
Well, certainly the number one is working really hard, really quickly. It's definitely an environment of deadlines, right? Because you're working on public company regulatory deadlines like audits and tax returns that need to be filed with regulators, right? So you have to do thousands of hours of work within a fixed period of time, and that puts a lot of pressure on you. And I think I've learned a lot about how to prioritize my work, how to make sure I'm working on the most important things first and putting other things down and delegating to my team. And one of the great things about working in public practice, especially when you work on large engagements, by the time you're in your late 20s, say 26, 27 years old, and you're a manager, you can be managing teams of 10 to 15 people. And so you start to learn just trial by fire how to be a manager, how to delegate, how to coach, how to motivate people that are otherwise burned out and exhausted. And that's an incredible experience at that age and that stage of your career where you're less than 5 years into your career and you're already a manager of a significant team. And so it's a pretty fantastic experience, no doubt, and has lots of lessons that you can apply even outside of public practice.
How did you go from working in public practice to becoming VP Finance and Operations with Burrard then?
That's an interesting story. So I was 27 years old, and I was first year manager, and we had just won a really exciting engagement. We'd won the Ritchie Brothers Auctioneers audit, which for us was going to be one of our largest clients. And so we were out celebrating, having dinner, and I managed to sit next to the managing partner of the entire office at dinner. And sometime towards dessert, she leans over and she says, "Hey, Doug, I've got this neighbor that is the chair of the board of this not-for-profit art gallery in North Vancouver, and they're looking to replace their treasurer. You seem to be a pretty, ambitious young guy looking to branch out. Would you be interested in going and talking with my neighbor about this role?" And again, I'm in my mid-20s. I'm an ambitious guy, and this is the managing partner. So of course I say, "Yes, ma'am, of course." So I go out and I interview and fortunately get the position. And so I spent the next 6 years as the treasurer for the Polygon Gallery in North Vancouver, which was exciting because when I joined the board, the organization was going through the early stages of a real estate development. Really, it was building a new roughly $20 million construction project to build a brand new gallery on the waterfront at the base of Lonsdale Quay. And so it was a lot of, working with partners, working with government, working with lenders, and really going through the motions of a proper real estate development project. Again, in my late 20s, and ramping up operations and turning it into a proper, multi-million dollar operation from what was previously a 1970s sort of schoolhouse venue. And so it was a great experience for me to get out of public practice, out of the pure accounting, audit, tax world, into starting up a business, operating a real business, having employees, and so on and so forth. And then about 4 years into the directorship, my current boss, Christian Chan, joined the board. And Christian and I are roughly the same age. We're now both in our mid to late 30s, and I think we were the two youngest directors, let's say, by a considerable margin. So me being an ambitious guy trying to win work for EY, and he being a young guy that's passionate about art and philanthropy, we just sort of hit it off. And another year went by, maybe a year and a half, and at that time, Christian was working on his first major project at Burrard, where I work now, and it was the early stages of a 41-story condominium project in Seattle. And Christian said, "Hey, Doug, I'm starting this really bold, ambitious project, and I'm starting to take the reins on a lot more of the company. And I'd really like to have a guy that has some of your expertise in finance, accounting, and more of the compliance-related skill sets to come work with me at Burrard." And he just said, "Hey, why don't you come over and be my sort of right-hand finance guy?" And And for me, it was not an easy decision. Of course, I was on the partner track and had this great thing going at EY. But on the flip side, I also had two young kids, and I wasn't getting a lot of time at home to see them. And public practice can be quite a grind for sure. I mean, you're being paid to learn, and it's worth it for a certain period of time. But life's priorities change, and so I took the leap of faith, and it's been the most incredible career decision I've ever made, because I'm having so much fun. Even 5 years later, I'm having so much fun every day at Burrard.
Awesome. How would you explain what you do in your current role then?
When I joined Burrard, I was vice president operations, and there was no job description. It was intentionally vague, because the company is really entrepreneurial. It has the benefit of being family owned, private, opportunistic, right? And we can decide to do things that a company that has institutional investors or is publicly traded maybe wouldn't be able to do. And that means down to a day-to-day level, I'm doing lots of different things, whether that's interfacing with debt and equity partners and updating on how projects are going from a financial perspective, or working on financial decision making and analysis, whether that's financial performance on a new real estate development, or deciding on pricing for a property we're looking to sell, or interfacing with brokers. A lot of my time is spent on just looking at our capital allocation and our financial strategy, and how does our company's next 5 years look from a financial perspective, and where are we allocating our capital, and how does it fit with our strategic plan? And then, of course, oversight of our finance department. So that's accounting, payroll, HR, legal, admin, insurance. All the sort of left-brained activities of Burrard are under my review. So it's different every single day, which is what makes it really exciting. But sometimes I'm working on other things. If there's an operational issue, or there's a process that's broken, needs to be fixed, I'll try and jump in and help with that. Whatever needs doing, you should like to step up to the plate, because to me, what I've learned over my career is new experiences bring growth.
Yeah, no, thank you. It sounds like a very unique opportunity. Well, it'd be good to perhaps learn a bit more about Burrard Properties, which had a slick rebrand recently. I follow you on LinkedIn, and I saw you kind of promoting that a few months ago. Some of our Vancouver listeners might be unfamiliar with the company too, but chances are they've seen the giant mural on the side of 1030 West Georgia. So what can you tell us about the company, and how would you explain the ideology and what makes Burrard stand out?
As you mentioned, it's a family company dating back to the late 1970s. And the Chan family, started it in California, and really spent a lot of time in San Francisco, working on commercial real estate investment and development activities down there. And it wasn't until the late 80s, early 90s did the company really, in a meaningful way, move up to British Columbia and Vancouver. And as the company grew, started to diversify. So we work in all kinds of different real estate avenues, whether it's golf courses, hotels, restaurants, industrial development, investment. And so it's interesting now, over the past couple of years, I mentioned my boss, Christian Chan, is taking the reins a bit more, and we've decided to launch Burrard Properties, which is a bit of an offshoot of Burrard International, the legacy company since the 1970s. And our new strategic plan focuses around creating engaging places that meaningfully improve quality of life. And so that means we are trying to create better urban experiences, whether that's through a well-designed residential property, a charitable initiative, maybe it's a hospitality establishment that promotes health. And we're really trying to exist to improve the lives of people who are using the spaces that we create. And we like to think of that as both inside and outside the property lines. The family is very well known for philanthropy. A lot of your listeners may have heard of the Chan Center for the Performing Arts, and more recently the Vancouver Art Gallery donation. So, charity and philanthropy is a big part of our ethos and why we do what we do. From a day-to-day project perspective, recently we've been working quite a bit in Seattle. We like the market quite a bit. We just finished a 41-story condominium tower right in South Lake Union near the Amazon headquarters, called Nexus. It's pretty incredible architecture. It's four seemingly rotating cubes going up 410 feet in the sky. And our next project, which we're in the sort of design and entitlement phases for, is also equally, potentially even more exciting, near Pike Place Market, and it's being designed by a world-renowned architect, Herzog and de Meuron. So it's going to be quite an architectural landmark as well, and that's going to be a roughly 10-story mixed-use residential-focused building as well, for rent. So, we're focusing pretty heavily in Seattle for the time being. So I'm learning quite a bit about local Seattle regulations, business practices, laws, and so on and so forth.
Why is Seattle of real focus for the group? Maybe can you speak to the market there and why it stands out?
Sure. Yeah, I think it's really all comes down to fundamentals and looking at the sort of relative income levels, migration, the employers that are there. And when you look at Amazon, Microsoft, Starbucks, Boeing, Nordstrom, the list goes on, and there's huge satellite offices of Facebook, Expedia, Google. These are massive companies that have, tens of thousands of highly paid workers. And so it's just not even comparable really to a downtown Vancouver, which doesn't really have any meaningful corporate offices of that size. So when you look at that fundamental value of the population as well as the price of land, which again compared to Vancouver is fractions. You can buy development land in Seattle for fractions of what you buy it for in Vancouver, and it's not just us. You can see a lot of other Vancouver developers are down there. You see projects by Westbank and Ani and Boza and Intracorp and all the others. So I think it's compelling, and we'll see where we go from here. Certainly, there's lots of news about how people are moving out of big cities and into the country, and the urban environment is dying. I don't buy it, obviously, but Seattle is just so strong fundamentally that it's pretty attractive for us.
Yeah, no, thank you. And you mentioned some of the other Vancouver developers that have been down there over the last number of years, and I've certainly heard from these developers at the different industry events referencing like the challenges of building condos in Seattle in particular. My takeaway from that is just around how the US is known for having a litigious culture. Could you maybe speak to like why it is so difficult for these developers to produce condos down there like they would in Vancouver? Like, what are the main challenges?
Sure. It's interesting that Seattle and Vancouver are geographically so close together, yet the types of residential development are so different. Seattle, over the past decade, has been almost exclusively for rent apartment buildings, and they've built tens of thousands of them, whereas Vancouver has been quite the opposite. It's been almost fully condominium. And up here, it's a function of land values, and it's a lot more difficult to make an apartment building pencil with what you have to spend to buy land and construct a building versus what the yields you can get from rent. But in Seattle, you're right. It is the US where, lawyers colloquially will, sue you over a ham sandwich. But it's a lot of it has to do with Washington state condo law. So the first challenge is developers are only allowed to take a 5% earnest money deposit when they secure a pre-sale. So that's not a lot of skin in the game for a buyer when you look at how much risk there is to a developer to build a building and not have that buyer close. I mean, the developer is banking on that sale to be able to retire construction debt and make money on the job. So if someone doesn't close and all the developer is left with is a 5% earnest money deposit, I mean, sure, that covers a little bit of carrying costs for a while, some property taxes, some insurance, some strata dues, but not for very long. So there's a lot of risk, right? That if the market turns between the time the pre-sale is signed and when the closing happens, then developers can be left holding a pretty sizable bag. And there's been lots of stories in historical Seattle where that's happened, and entire new condo projects have been, auctioned off by construction lenders. So a lot of risk. And there is this sort of post-completion litigious risk where the condo law says that within a certain period of years after completion of a tower or a condominium project, the homeowners association has a right to go after the developer for defects in construction, and rightly so. But it's turned into this thing where lawyers with sort of contingency-based fees will go around to HOAs that are a year out from that sort of statute period ending and say, well, time to start, looking at lawsuits with the developer, and,
Right.
nothing to lose. All my fees will come from your winnings. And so you may as well. And recently there's been some good changes in sort of the laws around how directors on an HOA board are being put under the gun. Historically they'd had some fiduciary responsibility, and so lawyers would say, well, if you don't sue this developer, then you're breaching your fiduciary duty to your community as a developer, and so you personally could be liable, and there's all this fear. And so that's been taken out now. There's no more fiduciary liability to a director, so they have more ability to say, no, developer did a good job, there's no defects, I don't want to do this. But that's the perception of development of condo in Seattle, is a lot of risk, a lot of, both risk of closings as well as risk of being sued after completion.
Are you looking for a specialized recruiting partner to connect you with the people who perform in commercial real estate? At Highview, we partner with some of Canada's leading real estate companies. From national landlords, institutional investors, REITs and service providers, to local developers, third parties, and private family businesses. We are passionate about the Canadian real estate industry and enjoy discussing what's happening in the market. We also provide insight and advice on hiring trends, compensation benchmarking, career roadmaps, networking opportunities, and much more. Visit us at highviewpartners.ca or contact us directly to discover how we can connect you to people who perform.
Okay, Doug, well, I mentioned in your introduction that you recently authored a book on financial literacy called A Fighting Chance. So it'd be great to hear more about this. Who is it for? How did the idea come about?
Sure. No, about last summer, actually, a friend of mine from high school, he texted me and he said, hey, Doug, I've had this idea for a book since we were both 15 years old, and I finally wrote it. There's this new platform on Amazon where anyone can write a book and publish it on Amazon and have it sort of this direct to print model where if someone wants to buy it, then the book gets printed, and there's no out of pocket for inventory, there's no cost. And so really anyone can self-publish a book. And I didn't know this really existed. And at the time, we were in the middle of quarantine, and I had a little bit more free time on my hands because I'm not going to the gym anymore and I'm not commuting to work anymore. And I had recently finished up at the Polygon, and I was looking for my next initiative to give back. And so I kind of put the two things together and said, well, what's the most valuable knowledge that I have that I could put in a book that could do some good for society? And of course, I landed on my finance knowledge, being a CPA and having more than 10 years now of experience across a multitude of roles. And so I just started writing about what are the things that, if I could have a time machine and go back to grade 12 in high school, what are the things that I wish I had learned that could have done a lot of difference in the decision-making process that I went through with my money between then and now. And I just kept writing and writing and writing, and ended up getting to 170 pages of lessons. And the book, that's really the nature of it. That's why I called it the high school finance education everyone deserves, not the university or the midlife. It's really trying to get these financial lessons into the hands of the people that need it and can apply it most beneficially. And that's, anyone in finance will tell you, time is your most valuable asset when it comes to investing and growing wealth, just given the power of compounding. So that was the idea. It's now on Amazon and Indigo. It's Kobo Kindle. It's 10 chapters long. It's written in sort of bite-sized chunks that are quite digestible. If you wanted to read 5 minutes at a time and go through one concept and put it down, you easily could do that. And it tries to run through everything from fundamentals like compounding, inflation, taxation, all the kind of fundamentals of how money works, and then into more tactical things like budgeting, investing, debt, credit cards, real estate investing, reading financial statements, doing due diligence, even things like what are the mindsets, what are the traps that people fall into that are just ingrained in our our lessons from multiple generations of parents that, like us, got zero financial education in school. And so hopefully it's a useful tool for people that are just getting started out in their careers and are maybe 15 to 25 years old and are earning their first paychecks and aren't quite sure what to do with their investment dollars and growing their wealth, and give them a chance to really grow some meaningful wealth over their lives.
Yeah, no, it sounds great. Good for you, and I think quite good timing as well. What with the Robinhood app and kind of this generation getting into day trading anyway, maybe it would be good to start with the fundamentals.
Yeah, I mean, really, the timing, it seems like it couldn't be any better. And I was looking the other day on Amazon to see how the book was doing. And I looked in to see, what are the top books selling on Amazon right now? And just books in general, some of the top sellers right now are, Benjamin Graham's Intelligent Investor and Robert Kiyosaki's Rich Dad, Poor Dad. People in general are really into this investing thing right now, for better or for worse. And I tend to think it's a really good time for people to learn it properly, as opposed to saying, well, I'm just going to go and throw money at Tesla and Bitcoin and Dogecoin and all these sort of momentum, plays that have no sort of true multiple or ratio sense to them. So
yeah,
it's a great time. It's a great time to be releasing a book on how to do proper due diligence.
Yeah, I know, absolutely. Well, I've started following A Fighting Chance on Instagram and would encourage other people to check it out too. But they're really super simple, like digestible posts that you put out there. So a good follow. And I guess you mentioned like the demographic that this is for. But what would you say are the kind of the key? Well, I know there's 10 chapters. People can buy it. People can read it. But what are maybe some of the key takeaways that you might share with, let's say, the demographic for this podcast, which could be, people in their kind of early to mid careers.
Mm-hmm. Yeah, no. When people ask me, what are the top 3 things to keep in mind as a new investor, there's sort of 3 buckets, and those are when, how, and what. So when being, when should I start? A lot of people think, okay, I've got my first job, but it's really low salary. I'm in a starter position. I don't have a lot of extra money to put away. And I would say that you should start like yesterday, because the power of compounding is just so immense that even really modest amounts of investment when you're, say, 15 years old grow incredibly by the time that you retire. I always use the example of put $1,000 into an index fund ETF that tracks the S&P 500, really boring, diversified ETF. Over long periods of time, it's averaged 10% per year. And if you put $1,000 in this 10% compound growth fund over 50 years, I mean, that becomes over $117,000 by the time you retire. And that's a single $1,000 investment. But if you wait 10 years to start, that same $1,000 investment only grows to $45,000. So time is enormously powerful when it comes to investing. And so even if you can put $50, $100 a month away, it can really turn into some meaningful amounts of money over time. So that's the when. The how would be looking at what are the tools available to young investors through the government that give them advantages. So things like the tax-free investing, well, I call it the tax-free investing account. It's really called the tax-free savings account. I think it's a nomenclature error on behalf of the government, because so many people think the TFSA is just for savings.
Right.
But the tax-free savings account and RRSP and RASP, I mean, these are ways to either defer or eliminate entirely taxes on investment gains. And again, if you think about, you put $1,000 in a tax-free savings account, when it grows to that $150,000, $200,000 amount, and you have a $200,000 gain in your account, I mean, I don't think you'd want to pay 25% capital gains tax on that down the road, do you? So, so max out those accounts if you can, right? Max out your RRSP and your TFSA, and if you have kids, your RESP, before you start looking at non-registered brokerage accounts. And then finally, the what. I think it can be pretty intimidating to say, well, yeah, sure, I have some money to invest, but where do I put it? There's thousands of stocks, thousands of ETFs, thousands of mutual funds to choose from, and it can be pretty overwhelming. And I would say keep it simple. Again, put it in a really boring ETF. I always go back to the example of the bet Warren Buffett made, and I'm sure everyone who's listening to this probably knows who Warren Buffett is. But back in 2008, Warren Buffett made a bet with a New York hedge fund manager, and he said, over the next 10 years, I will bet you $1 million that the S&P 500 passively managed index outperforms your hedge fund with your egregious fees and active trading and trying to beat the market. And guess who won? Warren Buffett. He won $1 million. So it's very difficult to beat the market. Everyone tries to pick the latest stocks and try and get these absurd 700% returns, and that can work in the short term, but almost no one does it sustainably. So just keep it simple. Throw money away each month. Don't even look at it. Have it come out of your paycheck before it even goes into your bank account. Use employer matching programs if you have them. Otherwise, just take it off the top. Invest in yourself first. Don't fall into the trap of spending all of your paycheck and then investing what's left, because you'll find there's very rarely anything left. Invest first and then spend what's left.
Awesome. Thank you. Advice from best-selling author there, Doug Allan. Thanks very much. That's awesome. Listen, I'm going to let you go, but I want to wrap up with try this little question out. So you've shared with us that when you can, you're in the gym. I know you've got a couple of young kids, so not too much time on your hands, but you look like you enjoy a good meal as well, especially post-workout, no doubt. Let's think fantasy dinner. You've got 3 guests, dead or alive, you can invite to this dinner. So first of all, I want to know who are those 3 guests, and then I'd like to know your favorite starter, main, and dessert.
Sure.
Let's hear it.
Fun. Okay. Well, I would definitely be entertaining my guests at Gotham Steakhouse. I'm a huge steak fan. So, and I'm a classic guy. So I'm doing shrimp cocktail, a nice big ribeye, rare, and then a big New York cheesecake to finish. Red wine and throughout, of course. In terms of the guests, interesting question. I would say that mine are all alive. I would say number 1 would be Arnold Schwarzenegger, because he is a guy that came from nothing in Austria, and just a hardworking guy, right? That went through bodybuilding, acting, politics, and just grinded to get where he wanted to go. And he's an action hero. He's just awesome in so many ways. I'd love to talk to him. The second would probably be Robert Kiyosaki, who is my favorite personal finance guru. He wrote probably the most famous personal finance book of all time, called Rich Dad, Poor Dad, that inspired me in so many ways. And his book and his philosophy is really around throwing out the traditional lifestyle ambition of getting a job, paying taxes, investing in mutual funds, buying a house, and starting to challenge financial decision making and going, is buying a house a good idea? Not always. Is investing in mutual funds a good idea? Not always. And so on and so forth. And he's challenged me to rethink how I manage my money and how I manage my career, and how I can potentially find myself financially free a lot earlier than everybody else. And my third, I would have to say, probably Patrick Stewart. I'm a huge Star Trek fan. I'm a huge Star Trek fan, and so having dinner with Jean-Luc Picard would be something pretty extraordinary.
Yeah, that's a great answer. Well, listen, thanks very much for your time. Really, really enjoyed that chat, Doug. Appreciate it.
Likewise, thanks a lot for having me.
Thank you for listening to People Who Perform, the Real Estate Careers podcast brought to you by Highview Partners, a talent search and recruitment firm focused exclusively on Canadian real estate. If your real estate team is looking to find the best next hire, or if you're ready to make the best next move in your career, then reach out to Highview Partners today. Follow us on LinkedIn and visit us at highviewpartners.ca.